All right, let's talk about Target, because there's a really fascinating story unfolding there. On the surface, you might think the company's in a bit of trouble, but if you look just a little bit closer, you'll find they're hiding a secret weapon that's completely changing the game. So, let's get into it.
So here's the big mystery, the paradox that is Wall Street scratching its head. Target's stock price shot up after their last earnings report, which is great, right? But their overall sales actually went down. How is that even possible? How do you make investors happy while selling less stuff? That's the puzzle we're going to solve today.
Okay, so let's start with the good news, the part of the story that got everyone excited in the first place. When Target dropped its latest earnings report, on the surface, it looked like a home run.
And this was the magic number, right here, $2.05. That's their adjusted earnings per share. Now, Wall Street analysts, the folks who get paid to predict these things, they were expecting a little less. So beating that number, that's a huge green flag for investors. It signals that the company is managing its money really, really well. But hold on, because here's where the story gets complicated. While the profits looked great, this number tells a totally different tale. Overall sales actually fell by almost a full percentage point from last year. So think about that for a second. They're making more profit while selling less stuff. Bizarre, right? And that brings us to the million-dollar question. If Target isn't making more money by just selling more TVs and t-shirts, where is all that extra profit coming from? Well, the answer reveals what's really a tale of two Targets, one that's kind of struggling and another that is absolutely on fire. And that booming side of the business? It all comes down to their incredible digital operation. This is where Target isn't just surviving in modern retail, it's actually thriving. This chart just lays it all out perfectly. You can see the overall sales number there in the negative, but look at the digital sales, up a super healthy 4.3%. This is the engine that's pulling the whole train right now. It's so strong, in fact, that it's basically covering up for the weaknesses they're seeing in their physical stores. So how'd they pull this off? Well, it's pretty much a three-part strategy. First, they launched Target Circle 360. You can think of that as their version of Amazon Prime. Second, they poured a ton of money into making their same-day delivery ridiculously fast and convenient. And third, and this is genius, they expanded their delivery platform Shipt to serve over 100 other stores. They turned a huge expense into a new way to make money. And when we say same-day services, we mean the whole shebang. We're talking about their drive-up service, which is crazy popular, curbside pickup, and of course, delivery with Shipt. Now get this part of their business grew by over 25%, a quarter. In fact, more than half of all their online orders are now fulfilled that very same day. In the world of retail, that is a killer advantage.
Okay, so the digital story is amazing, but we can't just ignore the other side of the coin. We have to talk about the very real struggles that are happening inside Target's actual brick-and-mortar stores. And here's the core of the problem. Target is in a tough spot right now. You see, competitors like Walmart and Costco, they focus on essentials. Groceries, toilet paper, the stuff you have to buy. But Target, they're all about discretionary goods, the fun stuff, clothes, home decor, new gadgets. And when people's budgets get tight, that's the first category of spending that gets cut. And the pressure is just coming from everywhere. Fewer people are walking into the stores. The ones who do are feeling the pinch from inflation, so they're skipping the fun stuff. On top of that, you've got things like import tariffs eating into their profits. And the result of all that? A pretty painful 3.8% drop in sales in the first quarter alone. Ouch. So, with all these challenges, what's Target's big move? Their answer is a major change at the top, but it's probably not what you think. They're making a calculated bet on someone who knows the company inside and out. So say hello to the next CEO, Michael Fiddelke. Now, the board looked everywhere for a new leader, but in the end, they picked him, and you can see why. This guy is a true Target lifer. Over 20 years with the company. He's worked in finance, merchandising, operations, you name it. He knows this business cold. Choosing Fiddelke sends a really clear signal. In these uncertain times, Target isn't looking for a risky outsider to come in and shake things up. Nope, they're betting on stability. They want a steady hand, someone with deep operational know-how to guide the company through these choppy economic waters. Okay, so we've looked at the good, the bad, and the new leader. So let's put it all together. What does this all mean for Target's future, especially if you're thinking about it as an investment? A quick look at the company's financial health shows, well, a mixed bag. Things like the PE ratio and price to sales suggest the stock is valued pretty reasonably. You could even argue it's a little on the cheap side. But see that current ratio? At 0.94, that's a bit of a yellow flag. It basically means they might have a tight squeeze covering their short-term bills, so managing cash is going to be absolutely critical.
But don't think for a second that they're just playing defense. They've got a whole offensive playbook for growth. They're pushing hard into things like AI, expanding their online marketplace, and even growing their own advertising business. And at the same time, they're not forgetting what people love about them. They're remodeling stores and leaning into their super popular house brands.
So what's the final word from the experts on Wall Street? It's basically caution. Most analysts rate the stock a hold, which perfectly captures the split personality we've been talking about. On one hand, yeah, there are some very real risks with their physical stores. But on the other hand, that booming digital business makes it a pretty interesting bet for investors who like to go against the crowd. And that really leaves us with the big, lingering question. Target has this incredible digital engine firing on all cylinders, and they have a seasoned, trusted leader about to take the controls. But they're also sailing directly into some strong economic headwinds that are hammering their core business. So will that digital strength be enough to power them through the storm and win the future? That's the paradox everyone is going to be watching.